You hear all these success stories, right? People building incredible wealth in the US market. But the reality is, for most of us, that journey is absolutely filled with hidden traps. A few simple mistakes can completely derail your financial future. So the real key, it isn't just about what you should do, it's about what you absolutely should not do. Let's break down the biggest errors that sabotage portfolios.
Honestly, this is probably the single most important idea in all of investing. Forget trying to find the next miracle stock. Real, long-term success is a game of defense. Think of it this way. It's not about throwing that amazing, game-winning touchdown. It's about not fumbling the ball on your own 5-yard line and losing the entire game.
So what are these big portfolio-killing mistakes? We've boiled them down to the 5 most common, and trust me, they're the most destructive ones. Let's walk through each one and I'll show you exactly how to sidestep them.
All right, so our first mistake, well, it's one that happens before you even think about buying a single stock. It is all about laying the right foundation. Okay, this one is absolutely critical. Think of your investment money as long-term fuel for growth. It is not your emergency cash. When life inevitably happens, the car breaks down, you get an unexpected medical bill, the absolute last thing you want is to be forced to sell your investments when the market is down. That's how a temporary dip becomes a permanent, painful loss.
So, how do you fix this? You build a financial firewall. Before you invest a dime in the market, your goal should be to have 3 to 6 months of your essential living expenses saved up. This money does not belong in stocks. It needs to be somewhere super safe and easy to get to, like a high-yield savings account. That way, it's not getting tossed around by the market, but it's still earning you a little something.
And this really breaks down the 2 different jobs your money has. Your emergency fund, that's your financial shock absorber. It's there to take the punches from life's short-term surprises so that your investment capital is totally free to do its real job, riding out the market's ups and downs to grow for the long term.
All right, with your foundation secure, we move to the next battlefield. And listen, it's not on Wall Street. Nope, it's right between your ears. The biggest threat to your portfolio is often your own emotional reactions.
When you really boil it down, the market is driven by 2 things: fear and greed. Letting either one of those get in the driver's seat is just the fastest way to wreck your portfolio. So let's look at the 3 biggest emotional traps that investors fall into.
Okay, first up, we've got panic selling. You know the feeling. The market drops 20% and your stomach just plummets. Your brain is screaming, "Sell! Get out now before it all goes to zero!" But selling in a panic is the single best way to turn a temporary, on-paper dip into a real, permanent loss of your money. It literally guarantees you'll miss the recovery that always comes eventually.
And then on the other side of that coin, you've got greed. And today, greed usually looks a lot like FOMO. That's the fear of missing out. You see some stock that's just going to the moon, everyone's talking about it, and you jump in because you don't want to miss the ride. The problem? You're almost always buying at the absolute peak, right before the whole thing runs out of steam. It's a classic recipe for buying high and selling low. And the last emotional trap is a sneaky one. It's the get-even trap. This is when a stock you bought just tanks, and you tell yourself, "Ugh, I'll just sell it when it gets back to what I paid for it." But here's the hard truth. The market has no idea what you paid. It doesn't care. Holding on to a loser out of pride just means your money is sitting there doing nothing, instead of being put to work in a better opportunity. So, let's say you've got your emotions in check. Now what? How do you actually invest your money? This is where we move from just gambling to having a real game plan.
Look at this. The biggest strategic mistake you can make is putting all your eggs in one basket. I mean, just look at the difference here. A portfolio that's all in on one single stock is basically a time bomb. One bad quarter, one bad news report, and you could get wiped out. But a diversified portfolio? It's built like a pyramid. It spreads the risk, making it stable enough to handle the shocks.
And here's the best part. Diversifying is easier today than it has ever been. You don't need to be some expert stock-picking genius. You can use simple tools like low-cost index funds or ETFs, which are basically just baskets of stocks, and instantly own tiny pieces of hundreds or even thousands of companies. It's like buying the entire haystack instead of driving yourself crazy looking for one specific needle.
Okay, next part of the strategy. You have to give up on the idea that you can predict the future. Trying to time the market, selling at the very top and buying at the very bottom, it's a fool's game. Seriously, the real wealth is built by remembering this classic saying, it's about time in the market, not timing the market.
So how do you actually do that? How do you put time in the market into practice?
Well, there's a simple, incredibly powerful technique called dollar cost averaging. It just means you invest a fixed amount of money on a regular schedule, say $200 on the first of every month. This takes emotion out of the equation and automates good behavior. When prices are low, your $200 buys more shares. When prices are high, it buys fewer. It's simple, automatic, and incredibly effective.
Okay, you've got your plan, you've mastered your emotions, you've got a strategy. But now you have to play defense against two silent killers that can eat away at your returns: fees and taxes.
Man, this is where so many people lose a fortune and don't even see it happening. Look at this chart. A tiny difference in fees can have a devastating impact over time. That extra 1.5% fee might not sound like much, but over 30 years, it could literally mean the difference between a comfortable retirement and having to work another decade. High fees are like termites in your financial house, just silently eating away at your foundation. Always choose low-cost funds.
All right, let's talk taxes. Because remember, it's not what you make, it's what you get to keep. And the government actually gives you some amazing tools to protect your investments from taxes, accounts like 401ks and IRAs. You should think of these as a greenhouse for your money, letting it grow and compound year after year, completely sheltered from taxes. It's one of the biggest legal advantages an investor has. And even when you're investing in a regular taxable brokerage account, you need to know this one simple rule. Hold an investment for less than a year and sell for a profit, you're going to pay a way higher tax rate on it. But if you just hold on for more than a year, boom, you qualify for much lower long-term capital gains rates. Patience literally puts more money in your pocket.
Whew! Okay, we have covered a ton of ground. So let's boil all of this down into a simple checklist, something you can use to guide every single investment decision you make from here on out.
So here it is, your 5-point Smarter Investor Checklist. It all starts with that solid foundation, then mastering your own psychology, and then just executing a simple, disciplined strategy. And the final, critical step is playing defense to protect your hard-earned gains from being eaten away. If you follow these principles, you're already way ahead of 90% of other investors out there.
And that brings us right back to where we started, with what is truly the most important idea of all. Forget about get-rich-quick schemes or finding the next big thing. Building lasting wealth isn't about some secret formula. It's a discipline. It's about consistently and deliberately avoiding these huge predictable mistakes.
So, I want to leave you with this one question. Take a second and really think about your own habits. Be honest with yourself. Which one of these mistakes are you making right now? Just identifying it, that is the first and honestly the most powerful step you can take to change your financial future.